Good morning, everyone. This is Marshall Gittler bringing you the morning comment for Thursday, June 26th. The third revision to the U.S. GDP figures were shocking. GDP was revised down from minus 1% quarter-on-quarter on a seasonally adjusted annualized rate to minus 2.9%. Revision is probably just a question of the timing of healthcare payments. If anything, healthcare spending is now likely to be higher because of President Obama's recent reforms to the U.S. insurance system, which gave health insurance to several million previously uninsured people. The market therefore expects a big bounce back in GDP in the second quarter. The consensus forecast is 3.5%, and that's all from forecasts made before yesterday's final figure for the first quarter was released. Now, forecasts are probably north of 4%. Following the disappointing GDP figure, interest rates are lower and the dollar's lower almost across the board. But stocks in the U.S. closed higher and Asian stock markets are largely higher this morning as well. In the current economic situation, where central banks in effect control the markets, it's official policy that determines a market direction. In that context, bad can be good if bad means rates will be lower for longer. In any event, GDP growth isn't that important for the direction of the dollar. I've been unable to find any significant connection between U.S. growth and the performance of the dollar. In fact, if anything, it seems that the dollar tends to decline against the euro when U.S. growth is higher than Eurozone growth. That may seem counterintuitive, but countries aren't companies, and a currency isn't the stock price of a country. Right now, interest rate differentials, particularly real interest rate differentials, are the major source of direction in the FX market. Note that the only G10 currencies to fall against the dollar overnight were the Norwegian krone and the Swedish krona, two currencies where the central banks have been revising down their expected rate paths. It seems pretty clear to me that the U.S. is likely to begin tightening policy far earlier than the Eurozone is, and so I'd expect the dollar to recover from this decline in the near future. In that respect, today's U.S. personal consumption expenditure deflator may be even more important than the GDP figure. The core PCE, which is PCE excluding energy and food, is forecast to have risen 1.6% year-on-year. That's up from 1.4% year-on-year in the previous month. This is the inflation measure that the Fed targets. In a recent statement, Fed Chair Janet Yellen dismissed the rise in consumer price inflation in the U.S. to 2.1% year-on-year in May as noise. But if the core PCE deflator starts to get close to the Fed's 2% target, speculation about an earlier hike in rates at the Fed is bound to heat up, and the dollar could appreciate as a result. Along with the PCE deflator, personal income and personal spending for May are expected to have accelerated, which could also help to dispel the GDP gloom. Weekly initial jobless claims are forecast to decline. Nonetheless, the 4-week moving average is estimated to remain unchanged. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.